Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Katrina Dudley of Franklin Templeton writing this. We continue to believe in a soft landing. Today's economy is better than it was at the beginning of the year. The one risk on the horizon is the impact of the presidential election. Katrina, I'm so pleased to say, joins us now. Katrina, before we get to the presidential election, we have to go to the fact that, we began the show saying that the runway to a soft landing is getting narrower and narrower. And you're basically coming out and saying, actually, it's completely the opposite, and people are getting more confident, and we have complete conviction. Can you just sort of bring that together?
Okay, so if we think about a soft landing, and you're talking about that runway being narrower, that's just the impact of data coming into the market and informing our investment opinions. So first of all, if we look at the beginning of the year and look at where we are, at the beginning of the year, the market was predicting 6 rate cuts. We were actually much lower in terms of the number of Fed rate cuts. So we were actually slightly more optimistic. The market has come towards us. It's interesting, though, because now soft landing is considered a bullish scenario. And I think that really, it just doesn't understand the resilience of the U.S. economy. It doesn't also look at the fact that there are opportunities outside of the U.S. market as well. So you look at valuations and everything. So, when we look at this soft landing scenario, we're very positive as we go into the second half of the year. I think that, we've got good earnings support. We have a labor market that is not inflationary, and we do think that if I look at the impact of AI and all of those things, we think it's positive for a lot of sectors.
Do you think Mary Daly is wrong of the San Francisco Fed? That this could be an inflection point, and that often it's sort of nonlinear when you see some kind of weakening in the labor market?
I think in terms of calling an inflection point is very, very difficult because you're calling a kind of point estimate in time. And we look at the fact that you've got a Fed, which we really do congratulate for the fact that they have been telegraphing so clearly what they're paying attention to. They're paying attention to inflation, and we've spent a lot of time talking about that because it's come from such high levels. They're also watching that unemployment number. But we're coming from historically low levels of unemployment, and so we can normalize unemployment and we can still have a supportive market.
I want to ask about what supports that market. The environment is positive, but we're talking about a soft landing. We're not talking about some huge growth engine. Or maybe, correct me, maybe we are. But how do the cyclical stocks catch up? If, again, it isn't this huge bout of growth, if it's just kind of this anemic soft landing?
An anemic amount of growth is actually good for companies. Kind of a really aggressive amount of growth where you've got so many things happening, it's very difficult to plan for when you're sitting in that CEO seat. When you've kind of got tepid, but you've got predictable growth, I think it's much easier to plan and to forward forecast. If I was to tell you that, we know that things are only going 2 to 3%, you can kind of get some productivity gains in order to be able to manage that, and so you can manage your cost in order to meet that revenue. When things are going, gangbusters, and your market's growing 10 or your revenues are growing 10, 15%, you're just adding bodies and you're adding cost, and then you take care of the efficiency. So I do think that productivity is where we're actually going to see some upward surprises in terms of driving earnings going forward.
Does this market make sense to you right now? I mean, maybe we want to strip out the NVIDIA to ask, does it make sense? But okay, let's say we strip out and you look at the rest of this market, a market where over the past quarter, it's been utilities and staples that have done well and the others have lagged. Do you look at that and say, okay, given we're trying to approach this landing, that all makes sense, or is something strange happening to you?
So the concerns about the consumer are not new news in the last couple of weeks. I mean, you talk about McDonald's, for example. They were 3-6 months ago talking about the fact they were seeing a shift in the consumer to being more cost conscious. And what does that mean? Well, McDonald's sees the shift. They use data. They use a lot of technology in order to be able to forward project. And they say, we are going to bring out more cost conscious offerings to meet the consumer where they're at. And that's a really key aspect of what a company needs to do. You need to understand what's going on. So we already have known the consumer has gotten more cost conscious. Going over to the oil prices and looking at what's happening at the pump, we know that that's also starting to pressure the consumer. Interestingly enough, a lot of people are using the strong US dollar to travel internationally. So oil prices are actually not such a big component of the cost of travel in this, summer vacation series as they've been in the past. So I think that there's just a lot of dynamics going on in the market, but we look at it, the fact that you've got a high-end consumer supported by a strong stock market, and they're very much a driver. The middle-income consumer has got a lot of good things going for them, and the low-end consumer we're paying attention to, but that strength in the job market is really positive for them.
I'm glad you brought up travel, because in the consumer confidence survey yesterday, one thing they did notice, even though we have seen some subdued sentiment, is that most respondents say they plan to take, at least half were saying they plan to take some sort of vacation in the second half of the year. So does that still maintain this idea that, okay, we're seeing disinflation, but services is going to be the most difficult?
Services, in terms of what the number involves, the biggest driver there is actually the housing market and what's happening on the rent side of things. And that's a very significant lagging indicator. And so I think that the indication there is that that number is going to come down. So we really need to pay attention to that second derivative impact. So we do think that there's less inflation there. In terms of traveling abroad, it is the strength of the dollar that's really driving that. I mean, I'm heading over to London and to Portugal, and you look at the prices that we're going to be paying for accommodation, for trips and for travel, and it's significantly lower. And that's a really big driver for a lot of these travel.
Before we let you go, you said that the biggest risk was the election later this year. Is there a scenario in your mind about which presidential candidate could potentially be more disruptive to the market?
I think the reason we talk about the fact that the presidential election is disruptive is the fact that there is no clear contender for the White House that we can bank on, and you had some data earlier yesterday. So if I take a look at what we think is going to happen, each of them has a unique platform, and each of them has sectors of the market that will work if they're elected and not work if they're not. And that's the uncertainty that we're talking about in terms of it's the difference in policy and the fact that you don't have a clear person that is going into the White House. As a result, what will happen is that all of the stocks will price in the fact that you're going to lose. Everyone likes to price in their downside. So we do think that once we get through the election, we'll have that kind of those gains come back into the market, but we see the risk.
Katrina, Dudley, thank you so much. Dutta of Macro Renaissance Research, Renaissance Macro, writing this: the Fed needs to get on with it. The rationale for cutting policy rates is quite strong. In short, unemployment is up, core inflation is down. This is why a federal funds rate based on simple monetary policy rules that relate changes to unemployment and inflation to a policy rate suggest cuts now. Neil joins us now. Neil, I love this idea that you're on the same page with Mike Wilson after having quite a bit of divergence for a number of years. Why are you saying just get on with it? And why are you beating the drum right now, saying as loud as you possibly can, you are making a mistake?
Well, so I would say a couple of things. I mean, to me, it's just look at the realized data. The unemployment rate is up. It's up about 60 basis points from its low. So far, it's been rising about 30 basis points every 5 months, which all else equal would imply that it would be around 4.4% by year end. That's higher than where the Fed currently thinks it's going to be. And if you look at core inflation, after some wobbling earlier this year, which I think the Fed is a little bit too concerned about, generally speaking, the trend in inflation is lower. Core PCE inflation is likely to be around 2.5% in May. To me, it's thinking about which direction are both of these indicators going over the next 6 months. What's the risk for unemployment? Is it higher or lower from here? I mean, with initial jobless claims rising and the hiring rate low, I think the risk is that the unemployment may rise a little bit, not a lot, but a little bit from here. And with respect to core inflation, there's still a significant amount of disinflation in the pipeline. I mean, Powell's going around worrying about import prices. The dollar's basically running at year-to-date highs. That's going to put downward pressure on imported consumer good prices. We know that things like used car prices have more room to deflate over the summer. New car prices are already declining year over year.
Yeah.
And auto-adjacent services like maintenance, repair, motor vehicle insurance, those will continue to come down.
Well, Neil, I just want to break
in.
No, I just want to break in here because I understand all of these points and I think that they're valid points, and I would love to talk extensively about each individual one, especially in light of the fact that inflation came in hotter than expected in Canada, came in hotter than expected in Australia, and some people are arguing that some of these indicators are going to reverse into next year, especially if rates come down. I'm thinking of housing in particular. How do you assuage those concerns, especially given the readings we got in Australia as well as Canada?
Well, come on, Lisa. You're cherry picking some of the data. I mean, this is after, Canada's cutting because the inflation numbers were coming in better than expected a few months ago. So we're going to, look, these numbers ebb and flow. You have to have a fundamental framework for why the data will move the way they do. You can't just be a slave to the high frequency numbers as they come in, because that's a recipe for making a mistake. You have to actually have a fundamental framework for how these things will operate. Where is the upward inflation surprise coming from? If the Fed's cutting, it's interesting, financial conditions, people are making that argument. Well, if the Fed eases, financial conditions will ease, growth will pop and so forth. Look at mortgage purchase applications, Lisa. The fact that rates have been already coming down, if you look at 10-year yields, they've generally been falling. What's that done for purchase applications?
Hold on a second.
Not much of anything. Much of anything.
Neil, the thing is that when you talk about cherry picking data, you could cherry pick data any which way and you could tell a different story. It's not as if there's one overarching narrative that dominates. So it seems like you've coalesced around one set of data that is more important to you than, say, all of the perspectives that we're getting from, say, Carnival, with travel picking up, the idea of, certain, retail sales picking up.
The only data that matters, Lisa, is unemployment, U3 unemployment, which is, in a wide body of Fed research as the single best labor market statistics that we have. That was a comment from Janet Yellen back in 2013. Unemployment and core inflation. Those are the indicators that are in the Fed's SEP. You want to talk about Carnival, okay, for every Carnival, there's a pool, okay, fewer home renovations. For every Carnival, there's a Home Depot, okay? It's sort of, let's focus on what's in the summary of economic projections. That's ultimately how you back out the Fed's reaction function. In those projections are unemployment, core inflation. You want to talk about economic growth, they look at real GDP as well. Tell me what is the right tail for economic growth has basically been clipped. I don't really see much upside right now. I think growth is running at about 2. Maybe you can talk me into 2.5%. I wouldn't be lighting my hair on fire around recession, but there's not much upside risk.
Well, Neil, let me jump into this because I think this discussion in itself just really hones in on the point that people can come away with different ideas. Whether or not you think it's the right one is a different discussion, but the Fed is doing just that, Neil. I'm sure you would agree with Mary Daly about the inflection point of unemployment and of the labor market, but for every Daly, there is a Bowman who says that inflation could go higher and that they could be hiking. So in your view, if the Fed is, for some of them, setting rhetoric to yesterday's problem, when we do get cuts, how violent does it look?
Well, right now, if all we're doing is just waiting on a few more months of inflation data, then it won't look that violent at all. I think they could probably be talked into a cut in September, someone like Bowman, if the inflation data continue to sort of do what they did in May through the summer, then I think it'll be very difficult for even the hawks on the committee not to at least make a nod to cutting over the summer. And, folks like Governor Waller, all they're really doing, I think, is just following the last few months of data. That's kind of setting their tone. So in other words, their rhetoric is somewhat conditional. So if the data changes and their rhetoric quickly changes, then I think things will be okay. Now, if that doesn't happen, it could be a problem. I will say that I do think that, we'll get another soft June, inflation report. That'll be coming out, I think, in a couple of weeks' time. And as that happens, I think the doves on the committee are going to be fighting tooth and nail to make a more sort of meaningful signal at the July FOMC meeting. So that's kind of what I'm looking for.
Neil Dutta, Renaissance background. Jason Draho of UBS, alongside Blerina Uruci of Rowe Price. Blerina, I want to start with you. You had a call basically saying people are overly sanguine about how quickly the Fed could cut rates. Why do you say that?
Well, I think when I look at the U.S. economy, I don't see a lot of reason for concern and for a sharp deceleration. And then on the inflation side, we have had some progress, but the Fed chair has made it very clear that they have a different reaction function to, say, the ECB. For Powell, the first cut is consequential. They want to have confidence that by the time they cut, they will deliver a series of them rather than one and done and see how the economy plays out. So in this context, I don't see the rush. I see them as playing with this patient approach, getting more confidence on inflation and getting a clearer signal that the economy is really decelerating, which I don't see right now in the data.
Jason, do you agree?
I would agree. I think the markets are pretty sanguine about it because the Fed's been able to wait because the economy's strong. You think about where we were in mid-January. The market was pricing nearly 7 cuts, including the first one in March. Now we are a little under 2 cuts for this year. First one maybe September, and the S&P is up 15%, largely because growth expectations have improved. Earnings expectations have gone up. So if the Fed's waiting because growth is strong, that's not a bad thing for the markets. I think the path thereafter is kind of uncertain, but the timing I think is less relevant for the markets if the economy is doing fine.
The timing is less relevant for the markets, but what about the magnitude? We've been having this discussion really for the past week about a broadening out. What magnitude of cuts do you need for things like small caps, for the more cyclical parts of the market to actually become attractive again? So it's interesting. I think the consensus view is clearly among investors that we're going to have a soft landing. But I think there's lower conviction that the soft landing is going to consist of solid growth, disinflation, and the Fed can do insurance cuts. To think about what happened last November when inflation came lower, you had some Fed officials out there talking about maybe we can proactively cut. That's when small caps, that's when cyclicals really rally for about 2 months. Now it's a little bit concerned, well, maybe the Fed's going to come to the party a little too late and cut their rates. So I think the market needs to be comfortable that this whole sort of really benign macro conditions can play out to really want to rotate away from the quality growth tech stocks that have done well and broaden out into look to these more cyclical parts of the market. That probably won't happen for a few months at this point in time. Blerina, I want to bring that idea to you that Jason mentioned, this idea that is the Fed going to be late to the party? Because while for every dove like a daily that talks about the fact that the labor market is turned, there is a Bowman who talks about the fact that inflation could rear its head, and that would mean potentially another hike. Is there a risk of a policy error at that point when you can still hear that type of language as there are other metrics that start to soften?
I think this kind of language and talking about possibilities and risk scenarios is actually quite helpful. It does prepare investors to better understand the Fed reaction function. I do think that the bar to, say, hiking interest rates again is pretty high. It comes with accelerating inflation, but that would only happen if the economy itself is resilient and growth is reaccelerating. We're having here persistent inflation in the U.S. economy because demand is resilient. I don't think we're seeing the kind of cost push, wage inflation spiral. So I think this is important to understand. And then I hear a lot of talk about the unemployment rate and the recent increase. I would say that the unemployment rate is a very good summary statistic. It's very important. It's the Fed's target and so on. But this debate, I think, ignores the fact that there is some uncertainty about how reliable are household labor market data versus establishment data. Are we undercounting population growth and immigration growth in the U.S.? And I think this will all feature into the Fed's reaction function and their decision making.
I think from both of you, you're hearing a lot of strength. You're looking at a lot of strength in the economy. And Jason, to that point, why aren't we seeing that conviction in markets? Yes, we're seeing all-time highs, but we've been talking about all week. It's really on the heels of a couple of names or one name. It's not any kind of convicted sort of under-the-hood rally.
So I think if you look at market performance over the past, say, roughly 6 weeks, it's interesting because the tech sector is up for a lot. NASDAQ is up. As a result, S&P is up. But things like the small cap index, the Russell 1000 value, they're actually flatlining. And to me, that's a signal that the market's kind of skeptical about the growth story. And as valuations go go higher, as the market kind of goes higher, there's an issue where, like, do you actually want to chase that performance? Because again, maybe the growth is slow and we don't know. We've seen the data, especially for the past 8 weeks, economic data surprise to the downside. We don't know, is this asymptoting sort of like kind of a soft landing, or is it going the other way, kind of falling off a cliff? We just don't know yet. I think investors are a little bit cautious in believing like we're doing this when in fact we could be doing that.
Chris Harvey made a point that the reason why people are still, though, so bullish is that no one has been penalized. Earlier this year, people were talking about 6 cuts. That didn't happen, yet you do see the stock market continue to make new all-time highs. Is there something to be said for that? No one got hurt and continues to do well, just basically continuing on these consensus trades?
So I think I would kind of break it down to the macro fundamentals that we have an environment where growth should still be fine, around 2%. Inflation still looks like it's going to come down, and you have a Fed that's biased towards cutting rates. If you give me that sort of recipe, this is the macro environment, that's generally supportive for risk assets. And that leaves out the whole AI story of like kind of driving things higher. So if you have those conditions that you think still are generally directionally supportive, it's hard to get sort of, kind of too bearish in the markets at this time. The fact that markets are up, I think people are probably been underweight risk to some extent relative to how well things have done. I think we talked about this a little earlier. It's hard to, it's just as hard to be underperform as, when the markets are going higher as when the markets are going lower and you have too much risk on. So I think that's forcing people to kind of say, you just have to be invested. If you aren't, you're going to, at the end you're going to be lagging your performance.
And if you try to gather some sort of narrative to drive the market on a macro level, you'll probably drive yourself crazy, as I think we all have. Blerina, to that point, you mentioned the craziness of the labor market data, that you can look at a household survey that shows weakness. You can look at NFPs that still shows some strength. It is confusing. I wonder what you make of what you hear from corporates. Are you hearing any more clarity when you hear someone like a Carnival say that people are still going on cruises, or you hear pools saying that people don't want to build pools in their backyard, or Target yesterday saying that they're going to cut even more prices on their goods? Are you getting any clear picture at this moment from corporates and their exposure to the consumer?
So what I'm watching very closely is announcements of layoffs and how companies are discussing the tightness in the labor market. So what I see from the data is certainly a loosening in the labor market. Labor is not as hard to come by, and companies are not hiring at the fast pace that they did in 22 and part of 23. But at the same time, I'm not seeing widespread layoffs in all the survey data from the companies, but also the Challenger report and so on. So this suggests to me that we're not at the point where the labor market is about to sour, because if that happens, then we should start thinking, how sustainable is this recovery? So I'm getting a good signal from that. And then on the consumer spending story, it's going to be complicated and complex during this recovery. We are due for a correction in goods consumption, and that's finally materialized. Mind you, it's happening maybe a year or a year and a half later than consensus first expected it. But there is still some pent-up demand and resilience in services, and that's where Carnival and cruise ships and overall consumer discretionary services spending comes in. So again, it's not going to be a very clear picture, but understanding that this recovery is playing out in phases, and I think the services strength, that phase of services comeback, is not over yet.
So this really is an interesting point, given the fact that so much of goods spending has actually derived typically from home building and home moving and everything that comes around the housing industry, which has essentially been frozen in place for quite a while. We've been talking about this consistently for the past couple of weeks. It's very unclear, Jason, exactly what will happen when the Fed starts cutting rates. Does that lead to more volumes and more potential supply that leads to prices to go down? Or do you have all of this pent-up demand unleashed when mortgage rates go down just a little bit? Where do you stand on this?
It's a great question, because ultimately it comes down to how restrictive is monetary policy? Why have it not really kind of slowed the economy? And one would think if it hasn't really slowed the economy, then maybe cutting rates at the same time wouldn't be that stimulative. But I think there's an argument to be made that the housing market, we've seen when mortgage rates came down last fall, suddenly housing starts, home sales kind of picked up, that there's kind of this pent-up demand. I'd also think even for a lot of small businesses that rely, say, on bank lending, they're borrowing at higher rates than if you can go into the public markets and issue debt at really low rates, that if those rates come down, a lot of sort of holding off on making new investment, that could ramp up. So I think in the Fed's back of their mind, or probably front of their mind, is if we cut rates, is it something where the economic activity can reaccelerate pretty quickly, and then sort of financial conditions ease? We just don't know. I think it's kind of an open question. And the argument that it may not be that stimulative. I think there's a risk that it could really kind of ramp up activity enough that it just creates inflation concerns again.
Just to apply that to what you buy, does that mean that even if the Fed is cutting, the impetus for bond yields then to move down isn't as straightforward?
Well, if they're cutting and it ends up being stimulative, I think the risk is that the 10-year instead of kind of going lower, which is a typical pattern, the Fed cuts rates and you see the 10-year goes lower, that's kind of part of our thesis. The risk is that actually that's not the case, that they go lower almost reactively, and then it turns out economic activity isn't slow, and then we're 6 months, 12 months down the line, and you realize that we're still growing at 2.5%, and maybe the 10-year should be at 4.5%, not below 4%. I think there's definitely a risk of that happening.
Blerina, you have a lot of notes regarding the housing market right now, the inventory for the housing market. If we could just go back to that, what do you think will be the end game if the Fed if they cut, it's only going to be what, maybe 25 basis points, 50 basis points the entire year? Is that really enough for people to want to get in that have been waiting on the sidelines because they're so concerned about mortgage rates?
So here's how I think about it. First of all, I agree with the point that there is pent-up demand for housing. We started this hiking cycle with very tight inventory, and that has only gotten worse because builders are not starting new homes. We have the mortgage lock, so people are not bringing their existing homes into the market. So inventory has become even lower. I think the question here is, even what we know from the Fed is they want to cut and start a series of cuts. And I think what happens when they deliver the first cut is that the 10-year will respond. This is the risk, and will price even more cuts that maybe the Fed will eventually be able to deliver. And then this loosening in financial condition, and particularly in interest rates, could give the housing market that leg up and release that pent-up demand. It's not going to be about just one cut or two. It's going to be about what the 10-year price is and what the market price is for the Fed. That's the real risk here. And if that happens, we're expecting a deceleration in shelter, CPI, and PCE, and that's really fundamental to bringing inflation down to 2%. And then the next leg of that risk playing out is that the progress that we expect on shelter inflation is undermined.
Well, Renmac's Neil Dutta earlier this morning basically said, stop it with all of this, that basically if you look at the data and you stop cherry picking, as he told me in so many words, then you'll actually see that it's important to do an adjustment because inflation is coming down and growth is slowing. And so if the Fed doesn't cut now, they're going to risk having some sort of Fed error. Do you agree with that, Blerina?
I think it's very nuanced right now. It's more nuanced than that. I do feel like it's cherry-picking season at Bloomberg Surveillance this morning. But it's important to understand that in this complex environment, the patient approach that the Fed is delivering is the right one. We do have a lot of firepower should the economy decelerate. But I also am of the opinion that that first cut and the decision to start easing is very consequential because of how the market will price it. Just remember, in January, we were pricing 6 to 7 cuts. And so I'm not pessimistic on the economy. If you think that the Fed will deliver 2, maybe 3 cuts, that means that other people's baseline view is not for a sharp recession. And then in this scenario, just having more confidence on the progress on inflation is right. Waiting before you deliver on that easing in monetary policy.
Jason, is it cherry picking here on surveillance or just globally, generally right now, because that's all that people are left with?
I think it's more like a Rorschach test. Like if you have sort of preconceived notions and you look at the data and you sort of interpret it in the way you want. If you are optimistic, you can tell an optimistic story. If you're more pessimistic, you can tell that story. I think that's reality. Because I've had smart people on both sides say what Neil would say, that the Fed's going to be too late, and other people say it's crazy for the Fed to even think about cutting. The economy's not slowing down. And this is kind of the reality we're dealing with. Still data that's noisy, distorted, kind of from the pandemic. I'm most focused on Friday when we get the PC data, not the inflation piece, but the consumption expenditures, because we see goods going lower. But at the end of May, we set record travel for kind of going to the airport. So are people still spending on services, and that's strong, versus goods? So the picture is really kind of fuzzy, and I think, again, you can sort of draw your own conclusions. And that's a challenge, I think, for the Fed, but also for us. But as long as it's not really deteriorating, it's sort of still, I think, kind of generally risk on.
We like cherries. Jason Draho of UBS, Blerina Uruci of Rowe Price. Both of you, thank you so much for being with us.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.